Here is the contradiction that has traders scratching their heads this Monday morning. Hopes around an Iran deal are building, the sort of headline that normally soothes markets and lifts appetite for risk, and yet Bitcoin has slipped beneath $63,000. That is the level reported by CoinDesk in the early hours of the 3rd of August 2026, and it matters because 63,000 had been treated as a psychological floor by short-term traders. The reason being given is not macro at all. It is losses connected to Coldcard, one of the best-known Bitcoin hardware wallet brands, which have rattled confidence right across the market. In other words, the pressure on Bitcoin today is coming from inside the crypto industry, not from the geopolitics everyone was watching. So what has shifted? Until the weekend, the dominant story was geopolitical. Markets have been pricing the possibility of an Iran agreement, which typically pulls oil risk premiums lower and encourages investors back into higher risk assets. Bitcoin should have been a beneficiary of that. Instead, the Coldcard losses have taken over the narrative. Coldcard, built by the Canadian firm Coldcard, is a Bitcoin-only hardware wallet sold on a very specific promise, that private keys kept offline are safe from remote attackers. When losses are linked to a device carrying that reputation, the damage is not just financial. It touches the foundation of self-custody, which is the idea that you can hold your own Bitcoin without trusting a bank or an exchange. The immediate impact is on ordinary holders. Anyone storing Bitcoin on a hardware device is checking their balance this morning, and many are weighing whether to move funds to a fresh wallet or a regulated custodian. That kind of defensive shuffling tends to create selling pressure, because coins in motion often end up on exchanges. For British investors, the exposure is often indirect. Since the Financial Conduct Authority lifted its ban in October 2025, UK retail investors have been able to buy crypto exchange-traded notes on the London Stock Exchange, so a fall below $63,000 feeds straight into those valuations. Miners and leveraged traders feel it fastest, as sharp moves through a defended level frequently trigger forced liquidations. Near term, watch two separate clocks. The first is the Coldcard story itself. Confidence stories usually resolve on detail, so the speed and clarity of information about the scale and cause of these losses will shape how long the fear lasts. If the issue proves narrow and specific, the panic typically fades within days. The second clock is the Iran negotiation. A concrete agreement would likely soften oil prices and support risk assets more broadly, which historically helps Bitcoin recover ground. The key technical question is whether $63,000, now broken, turns into resistance on the way back up. Until it is reclaimed, rallies are likely to be sold into. Here is the lesson from the 3rd of August 2026. Bitcoin is often described as a pure macro asset that trades on wars, interest rates, and diplomacy. Today proves that is only half true. A trust problem inside the crypto ecosystem outweighed genuinely positive geopolitical news, which tells you that the security of custody is still the market's most sensitive nerve. If you hold Bitcoin, the practical response is not panic selling. It is verifying how your coins are stored, keeping your recovery phrase offline and never digital, and remembering that the $63,000 level is a sentiment marker, not a valuation.